All right, let's just jump right in. We're going to tackle a huge question today, one that's all about power, politics, and really the money in your pocket. This is a story that starts in the halls of Washington, D.C., but believe me, the shockwaves could reach every single one of us. So here's the central question, right? Is the world's most powerful central bank actually independent? The whole global financial system kind of hinges on this one idea that the US Federal Reserve is totally walled off from political games. But what if that wall is crumbling? Well, one argument we're digging into says it's not just crumbling, it's already been knocked down. And the whole thing starts with one just mind-boggling number. $36 trillion. I mean, just try to get your head around that. That's the US national debt right there. And according to the perspective we're looking at, this isn't just some number on a spreadsheet. No. It's more like a force of nature, and it's starting to bend our most powerful economic institution completely out of shape. And that's where the illusion comes in. The argument is that this mountain of debt, it's pulling back the curtain on something that's been kind of hidden in plain sight. And what's behind the curtain? The idea that the Fed is totally independent might just be, well, a convenient story we've been telling ourselves. A story that's now crashing head-on into the cold, hard math. Okay, so Section 1. The Fed under pressure. And this is all about a potential political drama set for 2025, one with truly global consequences. We're talking about a scenario where the White House is allegedly leaning on the Fed hard, creating a showdown that could affect, well, pretty much everyone. And this quote, it really gets right to the heart of the argument. The Fed's independence has always been a great selling point, right? But the idea here is that it was maybe always a bit of a myth. A kind of handshake deal that only works when the economy's doing okay. But now, the math of the debt is catching up, and that deal is starting to look really, really fragile. All right, Section 2, a myth of independence. Let's unpack the history here. I mean, is all this political pressure really a new thing? To get to the bottom of this argument, we've got to look back in time and ask, has the Fed ever been completely free from politics? So looking at this timeline, you can see political pressure is definitely not new. I mean, back in the 40s, during the war, the Fed was basically told to keep borrowing costs low to fund the war effort. Fast forward to the 70s, you've got the whole Nixon situation, where he reportedly pressured the Fed chair to keep rates down, which, well, a lot of people say that's what poured fuel on the fire of inflation. But here's the key difference being argued today. This isn't about a temporary crisis like a war. The pressure now in 2025 is coming from something permanent, something structural. It's the debt itself. Okay, Section 3, the debt dominance trap. This is really the core idea of the whole thing. It's when the government's debt starts calling the shots for monetary policy. The technical term for it is fiscal dominance. So what exactly is fiscal dominance? Well, in plain English, it's when the government's appetite for borrowing money gets so massive, so out of control, that it basically forces the central bank to drop everything else. Forget fighting inflation. The new number one job becomes making sure the government can keep borrowing cheaply. I love this metaphor. The fiscal tail wags the monetary dog. It breaks down really simply. Step 1, the government spends way more than it takes in year after year. Step 2, all that spending creates intense political pressure on the central bank to, help out. Step 3, the central bank eventually caves and starts helping finance all that debt. And boom, Step 4, monetary policy isn't independent anymore. The tail is officially wagging the dog. And this, right here, is the dilemma that the Fed is supposedly caught in. It's a classic rock and a hard place. Option A, they stand firm, they fight inflation by hiking interest rates, but that could trigger a massive government debt crisis. Option B, they give in to the pressure, keep rates low, and risk letting inflation just soar. The point being made here is that there's no painless way out of this. Next up, Section 4, the market's verdict. So you might be asking, okay, if this is all happening, where's the proof? Well, according to this argument, you just have to look at the markets. The claim is that investors around the globe are already reacting. They're voting with their wallets. And here are 4 big warning signs that are being pointed to. First, bond yields are on the rise. That means investors are demanding higher payouts because they're worried about future inflation. Second, credit rating downgrades. These are being called a major warning shot across the bow. Third, a weaker dollar. which happens when global investors start losing faith. And finally, you just see more volatility, more chaos in the markets, as that foundational trust in the whole system starts to crack. So, what's the solution to this mess? Section 5, a digital escape hatch. Faced with what looks like an impossible problem, the perspective we're exploring proposes a completely different path, an alternative that's supposedly immune to all this political drama from the ground up, just by its very design. And that proposed alternative? It's Bitcoin. The central argument here is that Bitcoin's monetary system isn't run by people, by politicians or central bankers. It's run by code. It was engineered from the very beginning to be the exact opposite of a system that can be manipulated by politics, to be immune to this whole problem of fiscal dominance. And this chart really shows the absolute core difference, the thing this whole argument hinges on: supply. With Bitcoin, the supply is fixed. It's hard-coded. There will only ever be 21 million, period. No committee, no politician, no central banker can just decide to make more. And that's a world away from traditional government currencies, which, as we know, can be created in basically unlimited amounts. So let's just lay it out side by side. On one side, you have the current fiat system. The supply can be expanded, it's controlled by centralized groups of people, and your trust has to be in those political institutions. On the other side, the argument goes, you have the Bitcoin protocol. The supply is fixed, control is decentralized, so no one's in charge, and your trust, well, it's not in people. It's in the math and the code, which is open for anyone to see. So what we're really talking about is a different kind of trust altogether. And that really leaves us with this one final, really big question. At the end of the day, what is our money built on? Is it built on unbreakable rules written in code? Or is it built on breakable promises? Promises made by humans that, when things get tough, can always be bent or even broken. It's a question that cuts to the very core of what money even is and what its future looks like.